Welcome everybody to our March Prospera Energy Operations Update and Conference Call. Good to see everybody back here, the listeners that have been with us here for the initial versions in January, February, and now the March version here for listeners who weren't here for the previous version. They are available on our YouTube for review as well. The format of these will be a iterative process. So starting with the January update was a comprehensive Prospera update. The February update that was done last month was more of a technical review session, plus a brief macro outlook. And as we continue on here, today's update will be more macro outlook focused, followed by a short update on our current strategies and where things are going. So anybody on the Twitter space that would like to join for the slides, the Zoom link is available on our website and in the previous Prospera news releases as well, where you can register and join us for the slides portion of this. And we will begin here. The Zoom will also be recorded here and put on our YouTube here after the presentation. There will also be a Q&A at the end of this for any questions. Of course, very interesting times in oil markets currently. So the topic for today will be the case for oil and the case for Prospera. As always, the presentation will contain forward-looking statements here relating to the future operations of the corporation. So please keep this in mind here as we go through this presentation. Talking about the agenda, we have a few slides here on the case for oil, and then a few slides here on the case for Prospera. And again, like I said, we'll end with a Q&A session there at the end. So part one, the case for oil. We have been in this structural bull cycle warming up for many years with the supply-demand dynamics, the inventory dynamics of where the world was going. And all it took was one spark to really have the world be aware of how critically low we were on inventories, how the structural supply crisis can really spiral out of control very, very quickly, and why the time for exposure is now. We've seen a big move in precious metals over the last 12 months. We saw an increase in the multiples on oil and gas equities over the last 12 months, and now set up here for the next leg up. Of course, with the forefront being the Iran-Hormuz crisis at current moment, February 28th, the day oil markets have been changed. About 20% of global supply at risk. Started off very slow with a disbelief on what's happening and has since then just escalated day after day. Almost zero tanker traffic going through the Strait of Hormuz, and about a 35% weekly gain on the WTI price, with $119 Brent intra-week high that happened on the Sunday night last week, and just growing from there. So a bit of the timeline: February 28th, U.S. and Israel launched the Operation Epic Fury, coordinated strikes on the military and nuclear sites. The supreme leader was killed. Iran had a retaliation, including missile and drone attacks on various U.S. bases in the area in all the Gulf countries. The IRGC ended up closing the Strait of Hormuz, which was a unknown at the time. Tanker traffic dropped to pretty much zero, and the big change was shipping insurers pulling coverage at the time. And then very, very quickly, we saw that some of the Gulf countries started to shut in production with lack of pipeline space, lack of tankers, lack of storage capacity. Now seeing multiple other countries join in on that as their own access to sell that oil is dropping. And then over the last few days, we've seen Brent settling in that $80-$85 range, despite the American administration wanting to bring this price of oil down. Hasn't really helped at all. EIA projections that came out a couple days ago have also spiked compared to how they are their usual conservative self. And there is no resolution here that seems to be in sight. Over the last couple of days, we see a big increase in WTI price again this morning, and just constant escalation with no end in sight for the current time being. The future strip of the WTI price has now started to come up as well, despite the 400 million barrel release from the G7 countries. as a group. So a bit more about the Strait of Hormuz. 20 million barrels per day of your normal daily flow, absolute choke point for basically all the OPEC plus countries that are in the Gulf area. 33 kilometers width at its narrowest, but the shipping lanes themselves are about 8 kilometers. So very, very small area through which you have multiple hundreds of ships going through per day. 84% of this is going to Asia, about 22% of the global LNG trade, and only about 4.2 million currently bypassable via pipeline. There is other, obviously, ways that people are trying to find ways for this oil to get out to market, but currently not confirmed as of yet. Who's trapped? All your major countries: Saudi Arabia, Iraq, UAE, Kuwait, and Qatar. Including, of course, these countries were the ones that were maintaining spare capacity, if you will, on the global markets in terms of oil supply, and all of that is effectively seized up in the same area for the time being. Why is this time different? In June 2025, we had the symbolic strikes on Iran. We had missiles still going. Yes, there was still chaos, but at the end of the day, the supply disruption never came to be. And again, the oil markets, the global economy went into a lull of everything is fine, nothing can ever happen. We can run with low insurance policies, no spare capacities, no oil inventories. Everything will be fine until it isn't. And that's where we sit today with a almost a full-scale war, you can say, including ships attacked and insurance pulled, and real supply loss with actual barrels cut down. Those barrels are not coming back anytime soon. And even when they come back, they will resume slowly, leading to a new floor in WTI pricing and increased confidence in this geopolitical risk premium that the world is going to have to take into account going forward. And we'll continue to track this on a day-to-day basis, monitoring the situation, if you will. So everything is changing, very, very, very dynamic. And we're just tracking not just the jargon and the propaganda, but also the actual supply loss is the big piece to track here. On the other side, you have US shale that has peaked. We shared some of these graphs in the last conference call, about 13.5 million barrels per day, responsible for over 100% of the world's requirement in terms of global oil demand increase over the last 10 years, and now starting to drop. We saw monthly consecutive drops here in the production on the EIA 914 reports. We're starting to see the massive consolidation start to lead to a new era of no more growth. The average Permian break-evens are rising as time goes on, and the expected US peak there has been hit last year in the 2025 timeframe. And just continuing to track data. This is not going to be a oh, this is just how it is type of statement. We are continuing to track rig counts, frac counts, US oil inventories, and where things are going here on a day-to-day, month-to-month basis. The EIA themselves have come out and projected the first production decline in 26. You've got your Permian Tier 1 inventory depleting, which has been at the base of this structural bull cycle for many years at this point. And you've got operators moving to the Tier 2 and 3 with about 15 to 20% less reserves and just higher capital cost on these wells. At the same time, you've got your Bakken and your Eagle Ford in structural decline. The Eagle Ford a bit slower, but the Bakken has been clearly declining at a very, very high rate here, as seen from the data coming out. Frac spreads have been dropping, and the rig counts have dropped about 40% in the last 3 years there. You've got other smaller issues at play, including the gas oil ratios and the water oil ratios. But the main piece here is inventory degradation in general, and an inability for producers to want to increase production on the barrels of oil category. The BOEs sometimes can rise with gas production rising over time. US shale was the marginal barrel suppressing prices. This is not just a real world phenomenon. Yes, they were suppressing prices because they were actually adding supply, but B, they were suppressing prices because the world just believed that US shale could always come to the forefront and rescue us in a very short time frame. I guess that time is now. So we will see what happens over the next 3, 6, 12 months and whether they can actually add barrels here or not. You've got some of the stalwarts of the industry cutting rigs, including Harold Hamm with his Continental Resources in North Dakota. The Dallas Fed continues to put out really good information on capital discipline and the break evens, and the world counting on US shale growth is again the really big piece here. Is that was at the base of the world's lull of just believing that shale can come to the rescue at any point if we saw higher prices. So let's see how that goes. At the same time, the other piece of the structural bull market was OPEC plus spare capacity, them staying in solidarity on keeping barrels behind pipe as the world needs, but also them not having as much as was put out there. So in April, their April increase was at 206,000 barrels per day. This was very, very early in the Iran issue here at play. So we'll see how they respond. 3 million of theoretical spare capacity sitting within Saudi Arabia and UAE. Can it actually get released? How fast can it get released? How long can they maintain it? And with the Strait of Hormuz closed, does it even matter at this point? Because it's all trapped. At the same time, some of this infrastructure has been taking attacks and unavailable to be brought online, obviously, if the fields are getting threatened. At the same time, the Houthi rebels are still in the Red Sea area, creating possible confrontation there. At the time, the Saudi Arabia's East-West pipeline has ramped up significantly with more ships coming. We'll again track this on a day-to-day, week-to-week basis as we go. And this rerouting, of course, takes weeks. This is not a video game where things are happening at the click of a button. Things take time to reroute, and that all plays into the actual supply loss that comes out. Demand. So you've got your supply side, you've got your demand side. 2025 global demand at a record still. 2026 demand growth continues at that 1 to 1.5% clip as we go. We'll again be tracking this as time goes on, with the price of commodities playing a disruptive role in that demand growth. The peak demand numbers keep getting pushed back. None of this is a surprise. This is the real world is coming to the reality of what it is. And about 60% of oil is used outside of transport. So it's not just the transportation industry that uses oil. The world itself is addicted to this commodity. And with Chinese and Indian growth continuing to really hit that S curve, neither has peaked thus far. Data centers adding incredible additional energy demand, mostly on natural gas, but just overall construction of the world. Petrochemicals have a structural 3 to 4% a year demand growth for the world's products, and aviation continues to rise, with Boeing and Airbus maintaining a 10-year backlog on airplane orders currently. So the scaling of global aviation will continue nonstop. And despite the EVs and renewables displacement, we continue to see this level of demand growth, which tells you that this is just going to be a structural growth throughout the next many, many, many years right now. And then you have your buffer. So the difference between supply and demand is very clearly shown in the inventories of where the world is. US SPR at its lowest level since 1984. There was refilling done over the last 24 months, about 40 to 50 million barrels. That will now get drained very quickly. Some of the reserves that China has been holding in their SPR and commercial reserves unavailable to global markets. Now they will stop importing as much and start drawing down that inventory as they need, but still not a massive buffer there. They have been a bit more strategic about this over the last 5 years. And we saw the G7 release here, starting with Japan, which is the most constrained here due to the 95% of their crude is coming from the Gulf, of which 70% is through the Strait of Hormuz. So the 16 million barrels per day disruption cannot be changed. It will be, again, a dynamic situation as we go. We have other inventory issues globally with the Iranian storage, the Venezuelan storage, and then the Russian sanctions. There's various different major dynamics at play with no clear, easy ramp up possible. Again, we'll continue to see this as time goes on. And global OECD inventories just globally at a lower level with a relaxation that should not have happened, a geopolitical risk premium that never got the right credit that it deserved, and just an overall lull in the markets that is now going to come back in a major way. So you have supply structurally constrained, you have demand very, very resilient, and these emergency buffers and insurance policies are no longer in place, not just from the inventory standpoint, but also from your US DUC count, US rig availability, availability of tier one acreage, private equity money flowing in is just not ready to scale at the rate the world needs it right now. Which brings us to Canada and why we're making a case here for Canadian oil, insulated from the Strait of Hormuz, but connected to global markets, both obviously through the US and the Gulf Coast of the US, along with the West Coast of Canada, with some of the new pipelines that have come in. You have a tightening WCS differential with heavy oil back in play here in a major way, especially with some of the Iraqi barrels offline, about 5 million barrels per day of production, and access to Asian refiners here right now that are scrambling for the supply. The heavy barrel becoming very, very competitive globally, and no disruption risk other than from the US Gulf Coast, which needs to remain open at this point, given that US refineries are unable to process as much shale oil as they produce. Which brings us to Saskatchewan and Alberta assets. Low decline, low risk, and capital efficient. This is a story that we've been pushing ahead at Prospera for the last 16 months since the new management and board came in, and now are ready to scale and ramp up rapidly with a proven strategy and financing that was secured as of Monday morning and news released. And just on the right side here, some price outlooks. Of course, this is a day-to-day situation on this piece. You've got the words, and then you've got the reality of how much supply is actually coming offline and how long it will stay offline going forward. So in conclusion, on the macro outlook piece here, supply is structurally broken here with not just the current temporary Strait of Hormuz GCC issue. You've also got constraints in other sanctioned countries. You've got US shale peaking and or has already peaked. And we have a structural supply crunch here with demand continuing to just absolutely rocket up uh, day by day, week by week, year by year. Your buffers are not as strong as they used to be. 2022 and 2023, a lot of the world's buffers were used up and then never replenished or taken seriously. You've got your price floor rising with higher dollars per barrel required to incentivize producers to keep going out, bringing more oil online, explore, and go and develop new projects. And the geopolitical premium of oil becomes a national security risk. It becomes an economic major risk, and it becomes for the politicians a re-election risk. So they are going to want to secure energy source there no matter what going forward, which brings us to Canada being the safe haven, zero exposure to these global issues right now. TMX specific access, a very, very strong WCS differential, and where capital will start to come in order to secure that resilient and safe and secure barrel. Chris, pass it on to you.
Thanks, Shabam. Excellent summary of the macro view. I think the world's really opened its eyes. It opened its eyes on Sunday night when WTI crude hit over $115 a barrel. The fact that we're seeing 300 to 400 million barrels of oil being released from the strategic oil reserves from over 30 countries across the world is really, really driving home the fact that this is a critical situation. When we see, 15 million barrels come offline, at various countries or Arab states here, this is a significant impact. And we're not going to talk about supply glut anymore. We're not even going to see that discussion anymore going forward. And I think we're going to see, you look at the oil price strip, we can see oil above $70, out for the next 12 months. So this is a significant event for the world and presents a An incredible opportunity for Prospera on a go-forward basis. And so kind of just moving into the next slide, Shabam. Quick summary for Prospera. The company did about 800 barrels a day in January 2026. This is a result of its ongoing strategy of reactivating existing wells in its Luseland field and its production from its other core assets in Saskatchewan, namely two water floods in Hartshill and Cuthbert. The company is 97% oil weighted, so it's fully positioned to be able to take advantage of this upswing in pricing. Sits on 2P reserves of about 6.8 million barrels, 159 million 2P reserves, and this is really just a tip of the iceberg with a very modest market cap of 18.9 million. Company's reactivation focus is focused on hundreds of wells across really the Luseland field is where the core of the reactivation happens. We already own these wells. The company is focused on deploying low risk capital in these shut-in wells and optimizing existing producers. We're not out exploring. We're not out drilling new wells. The oil is there. It's been produced from these wells in the past. And we plan on bringing those back online over the next 6 to 12 months. So it's not a drilling story. It's reactivation and optimization. Lower risk, faster payback, more predictable returns. Bit of summary of the company. We're composed of a board of entrepreneurs, ambitious entrepreneurs who contribute daily. We're not passive quarterly directors. Everybody's involved in this story on a day-to-day basis. 36% of insider ownership ensures deep alignment with shareholders. When the stock moves, the board feels it, and everybody is actively engaged in the story. We meet formally once a month, but discussions happen weekly, daily. Leadership continues, combines petroleum engineering, field operation, capital markets, finance, hands-on oil field management, and really pulls the entire story together. Just summarize or leave it the fact that every director is actually significantly invested in the story as well. So if there's a deep resolve to see this move forward, and firm commitment on that. So when we start to look at this at today's pricing, just to put that into perspective, what this means for a heavy oil producer like Prospera. An $80 WTI price equates to about a $90 Canadian per barrel price, plant gate per barrel that's being realized for WCS pricing, which is where Prospera tracks to. At $100, that equates $100 WTI in US dollars. That equates to about $115 a barrel Canadian WCS pricing, and so these prices are almost double what we've seen in the December-January timeframe. Not quite, but we're seeing 80% higher than what we were seeing in those months, and so that really starts to change the cash flow profile for the company. And so we've got a slide here that we put together, and actually had to add a couple more lines to this from our last presentation because we've seen such an upswing in pricing. But what does $70 WTI mean for the company? What does $80 WTI mean? And also, what does $90 and $100 WTI mean? So the numbers that you're seeing here are reflective of free funds flow. So the free funds flow is after cash flow from operations, after G&A is paid, after interest is paid, and after capital is deployed. What do we see as a return for the company? And so you can see on a modest basis, at a $70 WTI basis, the company is generating free cash flow of 1.3 million in Q1 and 3.4 million in Q4, and this is based on a fairly modest deployment with the cash that's already been raised in the recent equity financing. And so fairly significant even at $70, but today's WTI is trading at $95 this 10 seconds. So you can see on the purple line that we're we've got the potential to actually generate significantly more higher dollar amounts here. And I recognize that pricing stability is incredibly changing and dynamic on a daily basis here. We're seeing big swings, $30-$40 swings on certain days. So I don't want to get too excited about these cash flows yet, but just more to present that there is significant upside opportunity. And we'll continue to manage our operations accordingly. We'll continue to focus on the things that we can control, like increasing production, managing operating costs, so that we can see the best margins, realize the best margins possible going forward. So just a little bit about the valuation gap that we see here. The company is currently trading at a market cap of about 18 million. So this is discounted considerably from the true potential. The 2P reserves values, I think, were priced at about $70. And so, with the upside in pricing that we're seeing, there's considerable upside here potentially on a go-forward basis. Per share upside. NAV over basic shares, about 33 cents. NAV over fully diluted shares shows about 24 cents. And then even at 25% of NAV, the stock is poised to double. The discount exists, frankly, because of the legacy balance sheet, the negative equity, the elevated AP, and the decommissioning obligations. So these things that the company now has the ability to competently address through the year, through ramping production profile, through additional cash flow, AP reductions, and each catalyst narrows the gap. The macro environment is accelerating the timeline that we see these events unfolding. And so a known discount with executable catalysts. I really see that the company has the ability now to control its destiny on a go-forward basis on a much quicker basis under these pricing conditions. Go on to the next slide, Shubham. So this slide really just is a view on operational performance since November 2024. It's effectively providing you the gross profit that was achieved, so cash flow from operations, and the production profile that's been realized through this period. And Shubham mentioned we did just close the recent equity financing, so we do see potential executable upside on the production profile as we move through 2026. And so this is certainly by no means a guidance. I want to put stars and asterisks around this slide and the next slide here. This is meant to actually just show the potential of the company's production upside. We have a significant amount of reactivation targets. We've just discussed this in previous conference calls of over 100 reactivation targets that we'd like to bring online, pending capital availability. So the company has the ability to bring on significant production and gross profit as we move through 2026. Another piece that's significant is that the company is growing its oil inventory. So as it brings on these additional reactivation targets, it's building strategic flexibility and barrels in the tank that are not yet recognized as revenue. And so you can see how those inventories have increased last year just through the reactivation work that was done. So it grew from 11,500 barrels to over 20,000 barrels over 12 months, up 70%. These are physical barrels in the tank that are not yet recognized as revenue. We do expect this trend to continue, but we're also well poised to be able to take advantage of this higher pricing environment. So it represents over $1 million of unrealized value. And as the pricing environment pushes prices higher, the value of holding physical barrels increases. We are able to use this inventory as a little bit built-in insurance as well, so we can be protective over cash flow. But we can also use this in various different financing arrangements as well, as a bit of a leverage piece there too. So So balance sheet and cash flow trajectory. The main points that I want to highlight here is that when we look forward, and again, not locking this in as a hard guidance, but when we look out over the next 12 months under this pricing environment, given the fact that we're able to increase production, we see the potential for the company's shareholder equity to become positive, which is significant in terms of being able to attract additional equity and financing options. We see that the company has significant ability to reduce its accounts payable on a go-forward basis. And these are some of the reasons that I talked about before that allow the company to increase that market value and provide significant value back to the shareholder. We've got stable cash on hand on a go-forward basis, and we expect it to remain in place and being very protective and diligent about how we spend, but also how we maintain our cash balance in the event that, having gone through $55 and $60 oil over the last 6 months, we're very, very careful about how we deploy our capital on a go-forward basis, making sure that we've always got dry powder in place. One thing we know about the oil business is that there's always surprises that show up, and we need to be in a position to be able to handle those. But coming back to what I think is one of the most important transitions in 2026, not only from a production increase and a cash flow capability standpoint, but is this equity inflection where we see positive equity balance on the balance sheet trending towards that value for end of the year. Yeah, so why now? Why does an investor want to get involved in Prospera? Why do financing partners want to look at this story? And I think it really comes back to the fact that the company is well positioned as a junior, to be able to take advantage of this high pricing environment. We look at what happened way back in 1973 when we had the oil embargo, where we seen prices increase considerably. They tripled through a period of time. It wasn't the juniors that were originally positioned to be able to take advantage of this. Money didn't flow into the junior oil space immediately. It took a little bit more time, but it was a different scenario when prices increased back then. We didn't actually see damages to infrastructure. We didn't see, there was a war going on, but it wasn't a war in the Strait of Hormuz. So there wasn't actually transportation that was physically being blocked by another country. And so I see this as a slightly different situation, that there's significant potential here for prices to remain at this level for a considerable period of time. And we see Canadian juniors being the fact that Canada is looked at as a bit of a safe haven, but the oil juniors are well positioned in this situation. So with these prices surging, Canadian oil is the safe haven. Every dollar price increase flows directly to Prospera's bottom line, as you can see in the previous cash or graphs. The reactivation strategy is designed and built to be able to continually build the company's production profile. We've seen there's significant opportunity to increase this beyond 1,000 barrels a day. We talked about the discount to 2P NAV, so 88% discount to 2P NAV. Shareholders' equity being on track to turn positive in Q4 2026. And this provides a structural re-rating catalyst for the company's stock. Insider and strategic shareholders are subscribed in the recent financing, and you're seeing management and board putting their own money in at these levels. Operating netbacks are expanding from what we're seeing, $14, $15 a barrel to upwards of $40 a barrel as production scales and prices maintain. AP declining meaningfully, and the balance sheet is being repaired in real time. The valuation gap is the widest right now before the inflection. Shubham, maybe I'll pass it back over to you for closing remarks.
Yeah, thank you, Chris. I appreciate the full presentation there, and I think the comment here at the top really drives home the point. It's a macro tailwind with a micro execution results in asymmetric upside. We are not joking when we say that $57, $58 oil is an absolute grind. And we've lived through that over the last 16 months at certain portions while still being able to go out and deploy capital and prove out our strategy with significant wells now online in Luseland out of the 17 that we completed last year on these reactivations of wells that have been down for 10, 15, 20 years. We currently have additional wells coming online as we speak, as was shared in the previous news releases with the service rig active and bringing additional wells online. And that expected to continue here in a very, very strong manner, not just supported by cash flows, but by this recently closed private placement. We're really able to accelerate the growth profile to get the company finally stabilized and then start repairing the balance sheet in a much more major way as we continue on. And of course, the cash flows will justify the increased potential capital spend, the debt repayment, the AP repayment, really, really focused on getting this company back on track as the reactivated wells continue to rise day by day. So we have the updated key wells report here will be on the website by mid-afternoon here today. So as was promised to the investor base, we will remain 100% ruthlessly transparent to the market about everything that we're doing um, in the field through the key wells report and then through these monthly conference calls where the variety of topics will just continue to expand from here on out, not just covering macro outlook and or repeating the same thing over and over. We are going to bring in new topics to democratize the education of what we're doing from a technical manner, from a business manner, and just from an overall community manner as we grow our story here over the next couple of years, which a lot easier at slightly higher pricing and with a cleaned up balance sheet, which will be the strategy throughout 2026 here as we go. So with that, I thank everybody here for attending again. The YouTube clip will be available on the recording, and we open the floor up now for Q&A. Bring Sean here back if you wanted to start with the Q&A there.
Yeah, thanks, Shabam. We do have quite a few questions that came in here, so we'll some of these might have been touched on, but we'll start with will PEI do part releasing gravy barrels in the inventory to help with global supply? I know that was touched on a little bit, but
Yeah, so we maintain the optionality to do so. A lot of these barrels that we're talking about are fixed barrels in tank. So in the sense that you have to keep a certain amount of barrels for our central processing facilities to operate. We have to keep a minimum barrels in these reactivation single well batteries so that the burner tube is fully submerged and keeping the oil and the water hot enough for the trucks to load it. But there is optionality that gets maintained. We get paid at the end of the day on the monthly average of that month for our pricing. So as we get into the third and fourth week of each month, if we do see that ability for us to get a really nice average for that month, we do have the ability to deploy somewhere between 10 to 20% of our inventory into the market. And it doesn't necessarily need to be refilled. That's just extra inventory we're carrying. And I think the main point we wanted to make to the market alongside that is not only do we maintain that optionality, but that revenue hasn't shown up in our balance sheet over the last 7, 8, 9 months. As we've been bringing these wells online, we have been reporting higher operating cost than what's actually there in some cases because our inventory is going up. Our actual assets of the corporation are also rising at the same point. So I think it's a very important metric to track, and it's something that we release in our key wells report on a monthly basis.
do you see an opportunity for hedging right now?
I can take that one. Yeah, absolutely. We're in active discussions on hedging on two fronts. One is the WTI amount, and two is the WCS differential. We have the ability to hedge up to about 200 barrels a day currently with our current production profile. But as we increase barrels, we'd look to add to that additionally.
Okay, next one. There's a comment about asking about heart sale volumes appear to be going down and loose land increasing. Any comments on those properties?
Yeah, I can take that one. The company has strategically put capital into all three properties. When the new management and board came in late October of 2024, we were spending a lot of time figuring out what type of level of reliabilities are these infrastructures at, to the point that we started just learning as we went. This was a learning process throughout that time frame. And what we found at the end of the day is our dollar is best spent in loose land, not just in terms of barrels growth, but barrels reliability, the winterization that was done, keeping barrels online, and the continued growth in those barrels, given the continued increase in some of those wells as the sand cleans out, as we're able to speed the wells up 5 RPM at a time, and just get better and better paybacks out of those properties. We then went and completed the Cuthbert Pipeline project in October of 2025, added reliability, winterization, increased optionality there, which has been working out fantastic for us. And going forward, the company has a optionality here where, yes, we have hundreds of wells that we can go and fix, not just the reactivations, but some of the legacy workovers that have been sitting there. And the company has just strategically decided not to allocate capital to Hartselle at this point. And additionally, certain wells that were not making money were shut in. So we are not just chasing barrels numbers in order to hit a number and bam, we're good to go. It's about finding ways that we can reduce that overall cost on the system. Now, at $95 WTI, some of those wells become economic again. So we're actively looking at all of those economics on a well-by-well basis. But what investors can expect, as has been shared through some of the key wells reports on the production history, we will be allocating capital into loose land reactivations going forward, along with some Cuthbert workovers. The company doesn't expect to really fully capitalize Hartselle, even with wells they're available to capitalize at this point in time. Again, it's a very dynamic situation. So as the months continue here and certain wells become more and more economic, we may decide to go back there at a certain point in time. But what investors can expect to see is, again, complete transparency. We could have easily pulled the Hartselle graph out because it wasn't just going up and to the right. But we will be sharing that. And I think it's just been a strategic decision here to allocate capital where it's making us money, where it's 100% reliable. It's also to do with operating costs and royalty costs, the different kinds of landowners in the area. There is numerous considerations beyond just the well itself at the end of the day. And happy to take further questions through that. Maybe in the next April session, we can talk about the technical considerations and the economic considerations that we look at in order to provide some more guidance and information on that part of this question.
Maybe I'd add to that a little bit as well, Shivam. I think that's a great answer. Additionally, we've just entered into a contract for the summer with an asphalt producer that requires a heavier barrel. And so they need 11 to 12 degree API barrel, which this will actually turn out to be our highest netback barrel as well. So we need to ensure that we have the ability to meet this contract. And so our capital strategically has been allocated to loose land. Part and part, it plays into the larger corporate strategy, but it also helps optimize netback and cash flow.
Thanks, guys. Next one, there's a question with going into winter, asking about the ROI on, say, a snowplow acquisition, or maybe even any other internal equipment the company's acquired to keep costs down.
Yeah, I can start with that. So I just want to be clear for the sake of our insurance provider on the corporate Prospera is that we did not acquire the snowplow. We have strategic partners in the area that have acquired the snowplow and in some cases keep that close to or at some of our facilities with their own insurance policy. So with that disclaimer out of the way, this is an absolute godsend. Like I think the market absolutely has not given us credit for the step change that this offers, the ROI on it, as far as you can say, okay, we bought it for X, and then we're using it for X dollars an hour reduction in cost, already be justified. But I'll go a step further. Is that's actually not the real gain. The real gain here is when a well ends up taking a massive snowstorm and you can't get operators in there. That snowplow allows us to get in at the time that that well hasn't frozen over and then can be reactivated without requiring a steamer, without requiring a rod rig, without that well freezing up and then torquing up and having flow line issues, da 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 da. So we are able to keep our operational reliability very, very high in terms of fixing up problems. We are able to reduce cost massively. We are first in line always when there's a -40 spell. We're not renting out our steamers and our snowplows to other people. We get to use them first, as opposed to a typical oil field where the big boys like the Baytex, the CNRL, Strathcona's will always have more pricing power. They're able to go out and secure that critical piece of equipment when it's required, so that by the time Prospera gets it, that well's been down for 6 hours, or the flow line's been frozen for 6 hours, or half a day, or whatever it may be. We're no longer at beholden to anyone else. We keep our fields online. We're able to fix up issues way faster than relying on third parties. We still have strategic partners in the area beyond our equipment. Um, as needed basis and want to continue to do business with local community service providers and vendors. But I think the concept of ROI in this case is the fact that we're able to sleep at night knowing that if there's a major storm coming for 5 days, we're not just going to get stuck and have to shut fields in. We're not going to lose wells to torquing up because we haven't been able to steam them in a reasonable period of time and get it moving again. We're able to meet hedging minimum requirements on the contracts where we need to deliver X amount of barrels. We're just as a corporation way better structured running this type of model. And that leads to pressure trucks, vac trucks, the snowplow, the steamer. Those are the pieces of equipment we have already secured, and I will continue to secure additional equipment for us here going forward. So for us, between Chris, myself, our management team, our board, and our field operations team, it's very important we have our base structures and strategies in place before we accelerate our scaling up and growth profile. You don't just want to become chaos because we didn't have our structures and strategies in place beforehand. And 2025 allowed us to do that with our team and the data collection and the corporate strategies. So we're very excited to scale here with the commodity price tailwind, but also with the wells and the reactivation strategy having panned out, and now actively deploying it across the additional reactivations that we have in our portfolio.
Thanks, Shivam. Another question on specific properties. We have one that says, most of your growth appears to be in loose land and Cuthbert. Do you have plans to divest any of the others?
Yeah, I can start with this and then maybe get Chris's thoughts, but everything is for sale at the right price always. This is the way the oil patch has gone. We are absolutely to the core believers in loose land, so it would take a hell of an offer to get that out of our hands. Cuthbert, we're also very excited about with the infrastructure upgrades, the water injection plant upgrade, the VFD upgrade, the pipeline replacement projects, the re-winterization of the entire pool, the building of relationships with landowners. Very, very excited for the pool. Harts Hill plays into our core strategy because it's right next to loose land at the end of the day, where we have an absolutely incredible infrastructure built there, set up for secondary, tertiary recoveries down the road. So we've we would like to maintain optionality on our assets. That being said, there's obviously better assets where capital is spent today. And we're very, very active in business development as a company, regardless of asset divestitures or anything like that. Very active in our overall strategy involves the social media sharing of what we're doing, the monthly conference calls, the key wells report, the state-of-the-art kind of news reporting that hasn't happened in the junior space for many, many years. And that goes into our presentations. We presented with the Society of Petroleum Engineers. We will be presenting to APEGA. We will be presenting to the Artificial Lift Conference, and just sharing our strategies out there. So that does lead to a lot of inbound activity in terms of individuals wanting to get more information on our assets or looking to potentially acquire the assets. And of course, any firm deals will be disseminated through the proper news release channels, as it should be for a public company. Chris, if you wanted to add to that.
Yeah, we really like Saskatchewan. Our core assets are Luseland, Hartselle, Cuthbert. We like the production profiles. We like the long life, kind of harmonic type curves that are just flat forever, that don't see much decline. We like the margins that we can see potentially from this, the low risk profile here. We know exactly what we're getting. We've got central processing facilities and significant amount of infrastructure in these assets. We like the regulatory and environmental kind of operating environments. We met with the energy minister a couple of weeks ago in Regina. We also met with the CEO of SaskPower. We like the vendors that we've been able to establish relationships with, the landowners, the municipalities. I can go on. We put significant amount of time into having a long-term relationships in Saskatchewan, and we'll continue to deploy our capital there.
Great, thanks, guys. This one's a little longer. Your profile appears to be similar to Hemisphere Oil and Gas back in 2022. They put out an NR saying they would be able to pay off their debt within a specific time period. At that point, their equity increased. Does Prospera plan to do the same when reaching that point in their balance sheet? Thank you.
I can take the front of that. We aspire to look like Hemisphere in some ways. Hemisphere went through a period of time where they were having liquidity issues, and they overcame those. And so we see Prospera aspiring to that same level of performance. Hemisphere's done a really good job. They run a tight ship. I really like the balance sheet of Hemisphere, and so we do model ourselves after that company and steward towards cleaning the balance sheet and cash flow up similar to them. Shubham, maybe you want to comment on some of the technical sides.
Yeah, I think beyond the balance sheet, beyond the fact that they grew through a polymer flood, setup that our fields are absolutely set up to do as we grow Prospera. I think the big important piece here is operational execution. So we need to, as a company right now, with the macro tailwind we have, execute on this reactivation program, which has gone really, really successful throughout 2025. Come back and now execute on this in 2026 with this Q1 program that we have in place, and then in Q2 just continue to keep that momentum going by going out and being able to pay back debt, by being able to go out and continue to work with our service providers on the AP cleanup portion of the corporation, get the company consolidated into a cleaner story that's based on a clean growth plan here, and then just simply execute. And I think at the baseline of that is your low decline growth properties. So we're not seeing massive declines that are coming in, and us just continuing to need to put capital into the ground to keep production flat or even to grow it. We're able to keep production flat with a very limited capital profile, especially after some of the upgrades and the infrastructure work and the pipeline work that's been done over the last few months. feel very, very confident in this strategy going forward. So I think we have modeled after the Hemisphere story in terms of the production growth profile. We really, really like the way that they worked with strategic partners in the field and then also on the financing side to grow the corporation. And we're very excited, to be honest, about what we can build here in Saskatchewan. The amount of opportunity is massive. The wells that are being left for nobody's interested in these older wells. That whole setup is really good right now. We've been able to prove out strategies, build really strong relationships across the corporation, whether it's landowners, whether it's financing parties, whether it's with our board, whether it's with our field operators, really strong strategic connections there, and just looking to scale here. So it's very exciting to be into that, and we'll just continue to show results as we go. I'm 100% a believer in the idea of we will show you what we've done as opposed to going out here and making grand visions of what's going to happen. The reality is the macro tailwind is really strong right now. We have successful reactivations that we have already completed that continue to rise. Again, ask investors to check out the key wells report on our website here once it's updated about mid-afternoon. And now we're just looking to deploy the additional cash flow and the capital into the ground so the company can become truly sustainable and then can scale from there. So I think this is not just a hemisphere follow, type of story. This is the core of how a junior oil company should be growing, and we're very, very excited to be in this space with the kinds of reservoirs and the wells that we have.
Okay, I got a question focused maybe a bit more on the legacy side, but why is Prospera issuing guidance at $75 to $90 WTI, where in the past it's been a cause of underperformance?
So I want to make it clear we're not issuing any guidance in this call. We're simply looking at sensitivities at those ranges.
Okay, we're almost at the end here. We have a question. You mentioned the use of recycle pumps in your loose land reactivations. Can you comment on how those are working?
Yeah, I might be bouncing on the seat here. So these recycle pumps are absolutely fantastic. The strategy has come on very strong. We have had really good support from our field operators on collecting that data, ensuring this system is working really good, and we're now scaling the system. So not only are we going out and increasing the recycle pump uh, injection per day to bring more sand online, we're able to actually scale our new wells a lot faster. So given that we understand how the recycle pump works, how the sand cuts are working way better than we did 12 months ago, the 6-month scale up strategy that Prospera was using on certain wells in the past, we think can be shortened considerably. And part of that is happening as we speak with some of these wells that we are bringing online, these reactivation wells with the recycle pumps in place. We have done some additional science on how long does it take for the oil that we inject to actually reach 750 meters down hole, which has changed up some of the strategies around the startup of the well and how we're taking that first 24 to 48 hours critical phase right off the start, doing that. And even more excitingly, or maybe just as exciting, is that we can go back to legacy wells now and clean them up and put recycle pumps on them to get them operating at a much higher level. So the 9 cubes that Prospera was making out of loose land when our new management and board came in was a combination of about 10 to 14 wells that was doing that, because these wells are producing very low rates, like between 3 to 5 barrels a day. Yeah, they're cheap. We're not spending money on them. They're operating. But if that well can do 15, 18, 20 barrels a day, well, we're doing ourselves a disservice. So now that we've proven out this strategy, the recycle pump strategy on some of the newer wells, we're now no longer running smaller PCP pumps. We're going with a minimum 8, minimum 13 series chops pump with 1,500 meters of lift, which allows us to recycle more, bring more sand up on the new wells, and then on the older wells that are operating at 3 to 5 barrels a day, we can go back, clean them up, put a new pump in, bale sand, install the recycle pump, and get them going at way higher rates for a grand total of about $41,000 per well. So that includes the new pump, the recycle, the baling, the rig, the tubing, the rods, everything is about $41,000 a barrel, or sorry, $41,000 per job. So you can see if we can add between 5, 7, 10 barrels per well on those ones, we can now scale very rapidly. Operating costs come down significantly because we're going on wells that are already operating. We don't need to add anything uh, in order to have those wells make more other than this 41,000. And it's the same road, it's the same tank, it's the same engine. The operating costs we expect are going to come down rapidly here as we scale the strategy. It really is a very, very exciting time for us. We've been able to keep wells online for 6, 7, 8, 9 months already, which had less than 2 weeks of runtime over the past 5 or 7 workovers that were done by the variety of companies that have owned this asset in the past. So it's not just a 5% increase or a 10% increase. We are seeing like a universal level of increase here in the production reliability and that uh, sand wormhole propagation capability here as we scale. So really excited to say the least. And investors can expect to see not just continued updates from the Key Wells report. You will see now through our LinkedIn micro content videos a restart of talking about specific wells here as we go out throughout March and April and film some more content out there on some of the wells we talked about back in the summer of 25 when they first came online and how they're performing now. It's an absolute pleasure to be able to share those kinds of results here as we continue on our strategy.
That's great. Final question here, guys, and we can wrap up. You replaced 2 pipelines in Cuthbert in the fall. How many more pipelines will need to be replaced going forward? And has this been factored into the CapEx?
Yeah, so we replaced 2 pipelines at that point. We also replaced 1 pipeline in Harts Hill at that time. There is 4 to 5 additional projects we can do in order to replace those pipelines and get them done. But at this point, that is not a core capital component of the corporation. We are focused on the loose land reactivations. We're focused on the Cuthbert workovers. We're focused on some additional infrastructure spend required at the loose land battery, adding redundancy to the system now going forward as well. So a third water injection pump at the Cuthbert battery so that we have redundancy if we need, keep that reliability even higher, and maybe focus on the pipeline projects more into the after harvest season this year, which will be in that September, October, November timeframe. The company currently doesn't have that as a capitalizable project here in the near term. And once seeds are planted in the ground, we don't want to be going out and disrupting the farmers' operations anyway. So there's a 4 to 5 month window there where we can't do those projects more or less regardless. So we'll continue to share more through our future operations updates and through the news releases here on which exact projects we're working on as the corporation expands here.
Perfect. With that being said, I think we can wrap it up there. As Shabam mentioned, we'll have this on our YouTube channel within the next hour or two, along with the updated Key Wells report. We'll also send out an email blast. So if you go to our website, you can sign up for our email list. Appreciate everyone's time, and we'll see you in April.